Guys, let's get a little micro now if we can. We just went macro. Let's get micro. We got the 3 T's, we'll call that, right? And they're not tonic, although that will be used later on, I'm sure, by many people out there. Guy, let's start with you. Your old shop, Goldman Sachs, upgrading Twitter, saying this is going to be a long-term winner, in part because everybody's just stuck on the site watching all the updates.
It should be. And listen, I got to tell you, the last couple of quarters, have not been terrible. Obviously, the stock has been pretty much of a bust over the last 3.5, 4 months with pretty much everything else. But the concern I have now, it really comes down to ad spend. I can't say with any equivocation whatsoever what the ad spend is going to look like. So although you might have a ton of eyeballs there, and then you're going back to a 2000 term, unless they're getting the ad dollars to back it up, I'm not certain that's a great thing. With that said, I agree with the note. I mean, Twitter seems to be the one beneficiary of this if we can all come out the other side. So Twitter at current levels, if you want to play stock market a little bit, is a name you could start to pick away at for sure.
I mean, we're all on it. And Dan Nathan, I mean, that's the amazing thing about Twitter. It's like you got all these people that are on it. Everybody's watching it all day long, but yet just seems hard for them to figure out how to make money.
No doubt about it. Sully, I'm of two minds when it comes to Twitter. It's obviously become a very, very valuable utility to all different types of participants on that platform. But the fact of the matter is, this is a company that, and even in good times, was not growing sales at the sort of clip that you might expect for a growth company valued this way. I will tell you this. There is room between here and the 2016 and 2017 lows, and if it got down to the mid to high teens, the stock would be amazingly cheap. Right now, it has a $15 billion enterprise value. 3/4 of their market cap is in cash. It's got a brilliant, brilliant balance sheet. And if it ever gets down there, if there's a strategic that does not buy it, and I'm talking a Google or something like that, or a big media company, then I will launch a fund and I will go activist and I will buy it there, okay? Because this is an asset that actually needs to be paired with some other social assets or be part of a much larger platform, because they're just not doing it on their own to the sort of scale that would validate it ever becoming one of these mega platforms like we've seen Facebook go to become this massive behemoth.
Yeah, maybe a good add-on. That's a great point there. All right, let's switch gears to another T, and that is actually just the single letter T, the stock ticker. Tim Seymour, a scathing note by MoffettNathanson, $23 target, the low on the street. They said, you think about them just being a cell phone company. Moffett says, no, they're very cyclical. And the one thing that I think the investors on the equity side need to worry about is the CDS spreads. The insurance on the debt are starting to blow out a bit.
Look, a tip of the hat to MoffettNathanson, who put a $30 target on the stock when it was 23% higher, talking about the dividend coverage ratio, some concerns just about the debt, that they needed to actually de-lever before you got to a recession. They needed to do some other things. What they pointed out in their note today is that this is a company that wanted to get more cyclical, and they say, congratulations, you've done that going into a recession, where we're now concerned about your debt, and mostly concerned about the dividend and looking at dividend coverage ratios, which is essentially free cash flow and the dividend payment. And if you think about people that are investing right now in AT&T because it's paying a 7% dividend, this should be potentially concerning news. They give base, moderate, and severe recession cases, or mild, moderate, and severe, and they do their analysis very well, by the way. And I think that's the question. Look, AT&T 40% is still wireless. Their entertainment business is 25%. I'm long the stock. I do think that their cost of financing, though, has gone down dramatically as well. I mean, that's one thing that I didn't see really emphasized in this note, but good for these guys, and the street listens to them. And in fact, I think the stock was listening to them today.
All right, Steve Grasso, let's talk about Tesla. It's a good news, bad news story for Tesla. The good news is the deliveries coming in the first quarter, we got the numbers yesterday, look pretty good. The stock up today about 6%. The bad news is the stock's at 480. It was at 944 basically a month and a half ago. How do you read Tesla?
So Tesla's all about positioning. So obviously, to your point, it's been beaten down. But let's remember, they beat a low bar. They didn't give any guidance. And these are quarter numbers. They're not month numbers. And what always happens with Tesla is the bulls get a little overzealous. The shorts get a little fearful. The stock always, comes out a little bit in the wash. I'd be a seller of Tesla because I think going forward, you're going to be disappointed with these numbers. And I don't think it's any place to hide in a market as volatile.
Yeah, Dan, I mean, if you're that concerned about the economy, and you have every right to be, do we need to be that concerned about people buying $50,000, $60,000, $70,000 cars?
Of course you do. I mean, if you're an investor in Tesla and you're buying the stock here and you're not covering a short, you are whistling past the graveyard, in my opinion. I don't get it. You just set it up. Well, the bad news is that the stock was at 900 in January. It was the poster child for the excess that was going on in this market. It will be a major footnote when the history books write the story on this bear market. To me, listen, they shored up their balance sheet. Good for them. But to your point, Sully, this company was always a recession away from having, their product be something that, is just not particularly affordable for most people around this world. So the fact that they came in at 10,000 or 11,000 better cars on a $76,000 number, and that's about it. That's as good as it gets for 2020 for these guys. So I just don't know why this stock is levitating where it is. It should be lower, in my opinion.